Hey, what's going on, everybody? Wanted to come with a quick update on what I think is going on in the market. Some really good data I looked at because I went through this in 2007. I've been in this business about 20 years, and in 2007 it was pretty scary. And prices declined tremendously. We had a huge crash, but before that we also had a huge bubble. So over the last couple years, the last 2 years especially, a lot of clients, a lot of people have asked me, are we in a bubble? Do you think prices are going to crash? What do you think is going to happen? And of course, nobody has a crystal ball. But what I've been saying is this housing market's built on a pretty solid foundation. They ask for your firstborn to qualify, like it's full document loans, down payment. It's a completely different market than what we had before. Before, you were able to finance 125% of a home's value with stated income with a 640 credit score. No equity, no skin in the game. Like, it was pretty crazy compared to now, right? So my opinion has been, look, unless we have a huge economic collapse where there's just millions of people being laid off, I don't think we have to worry about that event happening. Well, now we're in a position where over 20 million people have filed for unemployment in the last 3 weeks. So that is coming to fruition. There could be a looming amount of foreclosures in the next 12 months, 18 months. Who knows how long this is going to last, and who knows when all of this is really going to start hitting the housing market as far as foreclosures going, because there are forbearance options, there's things happening, but at the end of the forbearance period, all that money's due. And we don't know what kind of financial position people are going to be in and if they're going to be able to make those payments. So here's what I wanted to go over and share with you guys about what happened before and what I think will happen now if we do end up with a ton of foreclosures. So let me see how I can share my screen here, and I'll show you guys some of these charts that I think were really interesting. I'm not doing a good job here of trying to share my screen. I don't know if it's possible. Anyways, I'll post some pictures in this after I post this video. But if you look at the home appreciation in 2000 up to 2007 compared to the appreciation we've had over the last 5-6 years, homes were appreciating on average over 10% a year during that housing bubble that led up to 2007, where now we're averaging 4 to 5% appreciation. So the appreciation we've had right now is much less than what it was up to 2007. Also, the credit availability. The credit availability up to 2007, basically anybody could get a loan, where now it's full documentation loans and all of that, right? So it's a solid housing market. Another big factor is there was an oversupply of homes leading up to 2007. There was like a 7-month supply of homes on the market, where now we're in a market where there's anywhere from 1 to 3 months supply. We're in a shortage of housing right now. So the demand is huge. So when we go from a market where basically the financing was completely broken, where the appreciation was double what it should have been, where the housing supply was insanely huge, compared to now we have a shortage of homes, we have phenomenal interest rates, so affordability is there, and we have people that really qualify on a solid foundation. So all of that leads me to believe our housing market now could sustain a lot more than it could then. But here's the biggest factor that I was really thinking about is in 2007, when all these foreclosures hit the market, that really is what started bringing prices down, when there's just a million foreclosures on the market, right? But then the banks got smart. Around 2009, 10, and 11, they started to have what's called this shadow inventory, where there were still a ton of foreclosures, but they weren't hitting the market. The banks stopped flooding the market with foreclosures to hold prices. So think about it. They probably learned their lesson. If we do end up with a ton of foreclosures going into the next couple of years, I guarantee you the banks are going to use the same philosophy. They're probably going to hold back a ton of those foreclosures so that they don't tank the market. So there's a lot of lessons learned from the government jumping in way quicker now with stimulus and trying to help sustain people, versus before it took months and months and months, almost a year before I saw stimulus packages. It was like 2 years before we saw any housing packages, all sorts of things, where the government stepped in way quicker now. And I think the banks are a lot smarter now, to where if we do end up with a large amount of foreclosures, they're going to hold those properties in another shadow inventory type situation. And at the same time, we still have a housing shortage, and we're going to maintain really low interest rates through that type of scenario. So I really think, maybe housing does come down a little bit, but I think as soon as we rebound from this, we're going to rebound quickly, and prices are still going to be strong, and prices will keep going up as long as wages and interest rates and payments are all affordable. As long as there's affordability and there's a housing shortage, the market's going to stay hot. So that's just my 2 cents. I'm going to post some of the graphs that shows the comparison to 2007 housing prices, inventory, credit availability. It's really interesting stuff. And if you think about it, in my opinion, I think that regardless of how we come out of this, we're going to rebound pretty quickly. We're not going to see nearly as much of a dip, and we'll continue to see the market pick right back up when things go, get hot again. But if the payment's affordable, and if you like the house, whether you lose value or equity or not, you're going to gain it back and then some. So just keep that in mind. If you have any questions on this stuff, let me know. Anyways, just wanted to share that. Thanks, guys.